The worrying part is probably that central banks are made scapegoats while politicians largely don't want to address the elephant in the room. And that is a very big challenge in this age. And it's no real surprise to me that more and more people are looking to the crypto universe to diversify their assets.
Hello, everyone. I'm Jen Sanasie, and you're watching Markets Outlook on CoinDesk. Joining us today to dissect a global economy where central bank policy and geopolitical risks are sending conflicting signals to investors is Chief Economist and Global Strategist at ADM Investor Services International, Marc Ostwald. Hey, Marc.
Good to see you.
Good to see you too. Let's just start with the question I like to ask everyone on this show. What are you watching lately? What's keeping you up at night?
Well, my perennial one is that we don't want to talk about asset price inflation, which has been induced by central bank QE. There's still 20 trillion of central bank QE out there. And in many senses, it's the source of a lot of our political tensions around the world, because whether it's housing or other things, a lot of people in the general public are being priced out of things which they used to think they were entitled to or they could work hard for and get to. And now for a lot of the younger generation, the idea of aspiring to own their own flat or house is a major challenge. And it is because of that QE. But otherwise, one is looking at this inordinately complex US tariff policy. I think it's underappreciated, now so complex with so many exclusions. We had another huge list at the weekend with an annex also saying, and these things may also be excluded. That for businesses and indeed for government, it is going to be inordinately difficult to administer and costly. And if we come around to the other aspect, when governments go to check whether the right tariffs have been paid, you can guarantee that there are going to be a lot of legal cases, which again is going to be a big waste of time and money. I'm sure we can all spend our time and money on that.
Well, let's dig into that a little bit deeper. I mean, just to make sense of this for the audience, can you draw on a time where we've been in this situation before and maybe use some of the learnings from that time to predict what might happen?
I don't think we've really been in this sort of situation since the late 20s and early 30s of the 20th century. Governments increasingly all look a little like Weimar type governments in Germany, and we know what that led to. Central banks are faced with the challenge of tariffs clearly pose a threat to growth globally. They pose both inflationary a threat above all in the US, but deflationary threats elsewhere. So trying to deal with that and balance that out is inordinately difficult. There isn't really, I think, particularly given the high levels of government debt wherever we are, any sort of precedent, unless one's going back to the 19th century, and that becomes very, very difficult as a comparison because capital markets just weren't free flowing there. But I think this is, with the tariffs, this is a little bit like going back to Smoot-Hawley in the early 30s. And with the central bank debt, the obvious comparison is with Germany, with its mountain of debt in the 20s and how that gets resolved. But the worrying part is probably that central banks are made scapegoats while politicians largely don't want to address the elephant in the room because they know it would be unpopular. And that is a very big challenge in this age. And it's no real surprise to me that more and more people are looking to the crypto universe to diversify their assets.
Well, let's talk about that. Gold recently hit an all-time high. It seems like people are looking for that safe haven asset, but Bitcoin really kind of trading range bound lately. Talk to me a little bit about your outlook on crypto and how it comes into the picture here in these circumstances that you've just laid out for us.
Well, I think, as with gold, we've seen the proportion of gold in central banks' foreign exchange assets rise dramatically. Now, central banks probably still consider the crypto universe, though perhaps not stable coins, too unstable. for them to diverse into for the foreign exchange reserves. But given the institutionalization that we've seen within the crypto sphere, I think a lot of people are just going to be looking at it more and more. They won't. This is not something which you have a massive allocation to, but if you can have less allocated to riskier assets, and indeed to assets where valuations now look so challenging, like tech stocks, you will be looking at the cryptoverse basically as offering somewhere where you can diversify your portfolio, because that's essentially what people are now looking at, that, that the safe havens don't really operate as safe havens anymore. Even the dollar is not really the safe haven that it was.
Midnight is introducing a novel approach to token distribution. The Midnight Glacier Drop is the first in a multi-phase distribution of the Night token aimed at empowering a broad, diverse community to secure the future of the Midnight network. Holders of ADA, BTC, ETH, SOL, XRP, BNB, AVAX, and BAT are eligible to participate in the Glacier Drop phase. Help usher in the next generation of blockchain with rational privacy and cooperative tokenomics on the Midnight network. To learn more about the Midnight Glacier Drop, visit midnight.gd and claim your night. I'm curious to hear your thoughts, given the debt that we were just talking about. Given what we've seen the government in El Salvador do with Bitcoin, we've heard the government in the United States talk about a Bitcoin treasury. Senator Cynthia Lummis outlined a plan to leverage a Bitcoin treasury to start to address some of the debt in the United States. Do you think we're going to see more governments start to look at crypto in that way, given the situation that you outlined at the beginning of this interview?
Not in the way that the US is. I think you could certainly see it more. It's more likely in the emerging market countries, even larger ones. In Europe, I think it highly unlikely, though the Czech National Bank has said it has considered it, but in the meantime has said no, it's still too volatile for it. I think the problem is, what people really need to have a look is how much of this US idea or of the current administration is borrowed directly from the FDR era, Franklin D. Roosevelt, and what they did with the US is all the gold that was there. It seems to be heavily borrowed from that, and I'm not sure that it translates as well as they think it would.
Are we heading towards a recession?
I think we need to be a little bit careful. There's two things I say frequently when I'm speaking at conferences. One is we are basically in a massive economic transition, whether it's to do with AI, whether it's to do with the energy transition, whether it's about the balances of power in the global economy. We had the SCO meeting, the Shanghai Cooperation Organization, last week, with a massive show of strength from China, Russia, and India, highlighting that the world is no longer Western Europe and North America centric. And we're seeing that above all now in terms of global trade. What's saving China at the moment from this massive drop that we saw today in exports to the US, of 33% year on year, is a 24% increase in exports to Southeast Asia. So intra-Asian trade is picking up, and Asia is the world's engine of growth. In recession terms, what I'd say is we haven't got the visibility that we had pre-pandemic. So what we get in surveys is generally always more pessimistic than the outturn. It used to be the case pre-pandemic that surveys tended to actually be over optimistic in terms of global economic prospects, and the actual outcome was generally a little bit weaker. Now, the rule of thumb, and this is why one has to be careful when one talks about recession risk, is that surveys paint a too pessimistic view of global economy. You can see that above all in the Eurozone, in the UK, in the US. I do think that tariffs, along with the immigration policies, and the fact that the big, beautiful bill really did nothing to deal with the US's huge debt levels, they're all things which put all the risk towards recession. But if people expect 1-2% contraction, that's probably over-egging it. We're talking about a recession which would be -0.5%. So something which isn't encouraging for risk appetite, but not something which is basically, oh my goodness, what we're going to do because everyone's got so much debt and they really have no fiscal headroom to give support to the economy by borrowing more.
Let's talk about the U.S. for a second. Standard Chartered expects the Fed to cut interest rates by 50 basis points this month following the soft August job reports. What do you anticipate?
I've been of the view all year that we would get probably 3 rate cuts this year, all of 25 basis points. I'm not changing that view for the simple reason, yes, we have got a weaker labor market, but it's essentially flatlining. We're not talking about minus 200, minus 300 on payrolls, though we've had some pretty bad household survey numbers, but there's a lot of debate about its reliability. The other part of it is going to be revealed on Thursday when we get the inflation data. And this is the thing which is going to check the Fed as long as, it's not peppered with appointees from the government. And that is, we're expecting headline inflation at 2.93%, in core at 3.1%, and the monthly reading of 0.3. None of those are consistent with the Fed hitting target. Now, obviously it has a dual mandate, but it can be responsive to the weakness in the labor market and try to preempt some of that with rate cuts. But what it can't do is get very aggressive. And I think partly the political interference, markets would view a 50 basis point cut as much as they're discounting it now. Well, the chance of it now, as basically saying the Fed's basically thrown in the towel, giving in to the Treasury and White House. Who's in charge? And they would really worry about that. And that could set off something, the Fed will be worried about doing something which is too aggressive, which sets off chain reactions in financial markets. And, part of that also is looking at these very high tech stock valuations. Yeah, I mean, it's all a big momentum trade. Yes, AI is you definitely writ large over the future, but at current valuations, I think that's more than fully priced in. And if you had something basically saying, well, people are not going to have so much money to invest in their AI projects, i.e. a recession, and a big sell-off in financial markets, that's the last thing the Fed wants to do.
All right, Mark, the last thing I want to ask you before we wrap up here, before we started the interview, you said that there's something a lot of folks in crypto aren't talking about, and that's people in trade finance for commodities looking at the crypto industry as an alternative to funding. Unpack that for me.
Trade finance has become ever more challenging, not only because of all the disruptions we've had, supply chain disruptions, sanctions, tariffs. Banks have looked to de-risk a lot of their books. What they do now is tend to provide lines of credit to the big commodity trading houses, the Trafiguras, the Glencores, etc. But it's either a problem that you can't get access to that capital, particularly for the medium-sized entities trading in commodities and energy, or it's an interest rate, because we would think, oh, well, yes, but dollar interest rates are only about 4 3/4, 5. Well, for the commodity trade finance, particularly in places like Africa, parts of Asia, you're talking about dollar rate of 15 to 18%. So anything which can be done to lower that and also improve the availability of capital. So there's been a realization there's been a huge accumulation of assets, of money parked to a certain extent passively in crypto assets. Above all, stable coins, I think, would be the arena which a lot of people saying, well, how do we leverage this to provide trade finance? And it's something which it's in its infancy. But in a world where we've got so much volatility, where there are so many risks, the commodity world has always been very inventive in any case. Any challenge they meet straight head on. There's no, oh, well, we won't do that. It's like, no, this has to move from A to B, whether it's oil, agri, metals, or anything else. So what are we going to do about it? So that's why they're looking at it. And I don't think it's something which is probably that appealing as a topic for discussion for most crypto enthusiasts, but it is nevertheless an important one, because if you start getting more and more interest from that, as people look at it as a vehicle, a potential vehicle, start to innovate, for trade finance purposes, then there will be a lot more demand. That obviously is something which would underpin the cryptoverse very, very distinctly.
Marc, thanks so much for joining me on today's show. It was a pleasure.
My pleasure too.